All right, Matt the Mortgage Guy here. Today, I want to talk about inflation. More importantly, I want to talk about how inflation affects interest rates. As a mortgage broker, people always want to know where are interest rates and where are interest rates heading? What's going on in the next 3 months, 6 months, 12 months with interest rates? In today's video, I'm going to talk about the inflation numbers we saw today, how inflation affects interest rates, and what you can expect over the next 3, 6, 12 months with mortgage interest rates. Before I get into it, if you like straightforward mortgage content, real estate content, do me a favor, subscribe to the channel, hit that like button. It helps the YouTube algorithm. I really appreciate it. I won't belabor that anymore. Let's jump right into it. So, Consumer Price Index comes out with their year-over-year inflation number. A lot of people pegged it to be really high, mid threes, high threes even, and that was what some people thought was kind of crazy. It came back at 4.2%. And I think that many people I've listened to, myself included, have talked about like inflation is coming. Inflation is here. We can't just print trillions of dollars and expect there not to be inflation. If you don't believe little old me, believe people like Warren Buffett and Charles Munger. You know, they do their annual shareholders meeting and they talk about different things to do with business and the companies that they're invested in and the companies they own. These guys, if nobody else has a finger on the pulse of the US economy, I think these guys do, right? And they talked about between their companies, Coca-Cola is paying more for goods. And what else were they talking about? Like steel. They're in the steel business. They're in lumber. They're in real estate, right? Lumber's more expensive. Steel's more expensive. The ingredients that go into Coca-Cola are more expensive. Everything is becoming more expensive. That's what inflation is, right? And so the higher the inflation rate, the more interest rates are likely to rise. That's just a given, right? And so the lenders are going to demand a higher interest rate because their dollars aren't as powerful in the future, right? And so that's why inflation is directly correlated to interest rates. And I'm looking at my, mortgage bond chart over the last 90 days or so. And the last 2 days, and we're talking, today is March 12th, 2021. So the 11th and 12th of March has been red candlesticks down, meaning interest rates up. We've seen probably a 75 basis point worsening. I talked on an interview this morning. That is probably about a quarter of an interest rate on most rate sheets. And I'm not surprised. I've talked to numerous people and I probably haven't voiced my opinion loud enough. So I'm going to be crystal clear in this video. I'll put up this infographic, which I've shared in other videos, where it's a mortgage rate prediction and it's Fannie Mae, Freddie Mac, Mortgage Bankers Association, National Association of Realtors. All of them, unanimous, right, have mortgage interest rates going up. I was looking at scenarios for somebody this morning, 2.82% with no points yesterday, 2.93 with no points today. So up 1/8%, give or take, in 1 day. You can have, it might not seem huge, 1/8%, but that's 1 day. That can get pretty nasty over a period of time. And even if it's 1 day bad, next day we get a little back, another day bad, over time, you can see how that can go from 2.75 to 3.5 relatively quickly. And what that's going to do is that's going to decrease your purchase power as a buyer. And so I think that it's important to take that into consideration. And I think what's going on right now with tons of demand, and now I'm speaking to buyers, is that buyers are treading this thin line between, wow, to get my offer accepted, I've got to offer how much? I've got to offer 560. I'm really not comfortable going above 540. Well, I understand that, and I'm not here to push anybody to do something outside their comfort zone, and I'm not here to sell anybody anything because not everyone's ready. Not everybody's willing and able to do what it takes in this market to get an offer accepted. But if you add that 20,000 from 520 to 540, or whatever the numbers are for you in your market, and you get your offer accepted, is that better or worse than looking back in 6 months and having a 3.5% interest rate versus a 2.9% interest rate? And who knows what that price is, right? The price more than likely is higher. And I've said this on past videos, and I'll say it again. If if demand gets quelled because interest rates go up, which is what will happen, demand will diminish. Not as many people will qualify for as much, because somebody who's maxed out at 750 purchase price, once you raise interest rates by 0.5% or a full percent, they can only qualify for 700. They can only qualify for 660. Those are just random guesses, but for example purposes, that's not going to be enough to quell demand so much that we even out this supply versus demand imbalance, and all of a sudden we've got a 10-20% decrease in home price appreciation. It's more likely 2021 sees 10% price appreciation, 2022 sees 7%, 2023 sees 4%, and something like that, where home price appreciation slows down, but the fact that we have so little supply tells me that we're nowhere near. Something would have to come out of left field for us to see a serious correction in home prices. So that's it. The main point of this video: inflation is coming. Inflation is here. The numbers tell it. No matter what the Fed says and how many times they use the word transitory, I just don't buy it. I just think that inflation is here. Inflation is here to stay. And with it comes higher mortgage interest rates. Do with that information what you will. Take into account that the money borrowed for a mortgage is going to be more expensive later on this year into next year. Not a ton more expensive, not like you have to buy now or you're never going to be able to buy a house ever again. I'm not saying that. But if the rate you're looking at today is 2.9, it might be 3.25 2 months from now. It might be 3.5, 6 months from now. Plan accordingly. Take that into account. Take that into account when you're writing offers in 2021, May of 21 to be exact for this video. So hope this was helpful. Let me know if you have any questions. I'd love to hear from you in the comments. Great conversations, great interaction is had, not only in the comments, but Mondays at 6 p.m. Pacific Standard Time. I go live every single Monday, live Q&A. I'd love to see you there. So come check me out Mondays at 6 p.m. for YouTube Live or on the next video. Thanks for watching.